first start by asking you about the single supervisory mechanism. This banking supervision mechanism that you've set up only a couple of years ago has matured fairly quickly. Are you happy with the current state of banking supervision?
Well, I think we made huge progress in the last 3 years by identifying risks in the European banking sector, mitigating them, having a tough and fair supervision, defining common supervisory standards. But we are not yet done. As a supervisor, you will always have a lot of work, and there are challenges for the European banking sectors ahead, and it means for the supervisor to be, on your tiptoes and always look into the issues, the risk emerging.
We have seen a number of cases where the SRM and the SRB have gotten involved or looked at issues in Italian banks, even getting more involved in Banco Popular. Each issue seems to be dealt with in a different way. Do you envision a future where there's one single resolution process, or is it always going to be a different individual process for each bank?
Well, I mean, as banking supervision, the resolution process as such is always something what you focus on a single bank. Yeah, and we do have European laws, but we do have national laws with regard to resolution too. Talking about the Portuguese, about Spanish, about Germans or Italian banks, supervision is focused on the single bank. Resolution has to be done with the single bank. But I think we made huge progress if you see that it is possible to resolve systemically relevant banks. You can see it in the cases, in the examples of this year, that we ensured that it is possible and that we are dealing with the cases and that banks are able to be declared failing or likely to fail, which was not the case 3 years ago.
And surely the market has taken it in stride this year. It seems that investors have a fair amount of trust. The question is, how much trust can they have for the future? I mean, are the mechanisms adequate? Is the Single Resolution Fund adequate to deal with future issues?
Well, the Single Resolution Fund is building up over the years, and it will be adequate for sure in future times. And until then, we do have, and that you do not have to forget, an increasing level of capital, of loss absorbency capacities in the banks. Because when you look on the capital ratios of the last 5 years on average for the banks, you see a huge step forward, an increase in the capital ratios. We ensured that risk management, that governance has improved in the banks. And with regard to adapting business models, banks in Europe have made a huge step forward too. So the overall resilience of the European banking sector has increased significantly.
What about the issue of transparency with regard to capital ratios? Recently, we've seen filings from UniCredit, for example, that indicate they've offloaded some NPLs at a certain discount. It's not clear whether they've included fees to the buyers of these loans in their discount model. Can you guarantee the transparency of these kind of transactions?
Well, first of all, I'm not able, because of confidentiality rules, to talk about single banks. So for me, it is quite difficult, to answer to your question with regard to one case. But there are clear regulation about transparency with regard to capital ratios, and we look into the compliance with this transparency, as well as the market authorities are looking into compliance with regard to the transparency. So there is a focus on there, and I think the investors can be ensured that all of the public authorities dealing with this topic will do their job.
Will this kind of thing be dealt with also? You have a proposal now for how banks should treat NPLs. Currently, you're receiving comments on that, and it should go into effect, I believe, at the beginning of next year. Is this kind of thing going to become clear then, that there will be a delineation between the discount that a bank is willing to take for its NPLs and fees that it's willing to pay to the buyers of the NPLs? I mean, it's also complex and difficult to understand.
Well, first of all, right now we are consulting on a paper on general supervisory expectations for new NPLs, not for the stock, but for new NPLs. And this kind of paper gives and shows our expectations we have in general with regard to the provisioning of new NPLs. It's a kind of calendar, a quantitative calendar. We will take in the comments and we'll see what the public thinks about it. And it is nothing what is legally binding, and nothing what is related or linked to an automaticity. But we tell the banks what would we like to see, and please tell us where do you believe we are wrong in our perception, and give us evidence, give us proof whether our general stance is wrong. And after this kind of dialogue on an individual bank basis, then there might be some supervisory measures coming. So it's not a kind of regulation or a rule, but it is being transparent as a supervisor, what you would like to see in general.
Is it a concern? I mean, the ECB has proposed holding lenders to tougher provisioning standards, even if you don't count the current stock, and just looking at the future stock. Mm-hmm. Are you concerned that this could impact the monetary policy side of your job by weighing on bank lending, by slowing down the economy, if you propose too difficult rules or regulations for NPLs?
Well, I'm fully convinced, that only resilient banks with a clean balance sheet are reliably able to finance the economy. So from my perspective, as a supervisor and a central banker, we need to have strong banks, cleaned up banks in order to be the best, to have the best capacity for being a good transmission channel for monetary policy. So it fits together.
But we've heard a lot of banks concerned, here in Frankfurt, we've heard bankers concerned about the low interest rate policy as well. At the last ECB meeting, Mario Draghi said that interest rates will stay low well into 2019. Does it concern you that this is hurting bank profitability to an extent that it's not going to allow the kind of growth that you want to see?
Well, if interest rates stay long for a very long time period, then it is a challenge for a bank which is focused mostly on interest income. But you do see that banks are already adjusting their business model, diversifying their income sources, looking into the cost structures, etc. So, the main capacity of a bank should be to adapt to the macroeconomic environment you find as a bank, and the European banks are doing their jobs.
Banks like to see certainty. Investors like to see certainty as well. There was no end date set for the continuation of the quantitative easing program, although you said in a speech in October that we need to see a clear direction, step by step, steadily towards an exit. Are we going to get that?
Well, we will see what the economic environment and especially the inflation rate will develop to, and then there will be new discussions in the Governing Council how to react to that. I think it was correct to reduce the amount purchased from January onwards with regard to the asset purchase program. There are always some differences here and there, in the positions. And I made my point and my position clear in October, as you said. I would have liked to see a clear exit. There was a different decision made, and we will see in the next year how things are developing. When you look into the incoming data, we have a strong growth momentum. We have growth for 17 consecutive quarters. Now the labor market has a solid recovery. The sentiment factors are positive. The financial conditions for firms and households are very favorable. So I'm very confident that the inflation rate will pick up, that we will see in the medium term, and that is our goal, the medium term, we will see that we will achieve our goal. And therefore, for me, it was okay, to say we can already now move gradually, slowly, but clearly out of the non-standard measures, as the monetary policy stance will still be very accommodative, very expansionary. We will reinvest in the stock we already have. There will be a low interest rate for quite a time. And so for me, this is enough support for the economy in order to then move to our goal with regard to the price stability.
So but with that kind of confidence, do you think this will be the last extension of the quantitative easing program?
Well, I mean, I don't have the crystal ball, and I will always wait, for the new incoming data next year. Now we have a decision until September. We will see.
Got it.